Yeah, we start today's market talk. Risk wins again. So that's what we were discussing. Where on earth is that much anticipated global economic slowdown? There is no inflation in the US that Trump's tariffs were supposed to bring on, and that was bringing the global markets down. The US job market is doing well, and the big beautiful bill will deliver a big stimulus to the US economy. So resultantly, S&P 500 is already at lifetime high. So risk is winning right now as on date. Now coming to how to interpret the remarkable trends of the past 3 months. What we have seen is that US equity markets are scaling new highs. S&P 500 has edged past the February levels. I'll show you this. Bond yields have eased. Gold rally has stalled. Tech stocks are leading. AI is doing well. Tariff scare was overdone, and underlying fundamentals are back in control, and market has more room to rise. Because if the more money is going to be spent, like as brought out by the big beautiful bill, then it all flows into equity markets. Now, again, there was a lot of gloom and doom on US dollars. Fall of the USD is the story of the year, but a decline in the dollar is an orderly adjustment after a long period of overvaluation. So it is nothing alarming, not a sign that US is having trouble funding its last deficit. That is not actually it is good because their corporate results of big tech, which makes most of their earnings abroad, will be good because the US dollar is down. And though slowly and slowly, central banks are cutting their dollar reserves and buying gold and other currencies, etc. But it is nothing alarming. In India, though, nobody is quite sure about growth because PMI data was strong from 59.3 to 61, but IIP showed that industrial growth is slowing. I'll show you the IIP data. So this is for 2 months, April and May. So if you see, it is 1.88 for 25-26. It has declined as compared to last 2 years. And mining and query, etc. are declining. Manufacturing has declined. Electricity is minus. Capital goods, where the government spends money, is doing well. In the infrastructure, construction goods is okay. Consumer durables and consumer non-durables has declined. So it shows that industrial growth is slowing. Consumer goods production continues to contract, uh, which is basically is showing that government capex is doing well, but the private capex or private demand is not there. So NPC in India took a right decision in slashing the policy rates by 50 basis point. So it is just to inculcate more demand in the system. And auto sales for June and GST collection in June are also slightly weak. Now, lower nominal GDP growth implies possible EPS cuts. So that is the point. If the GDP slowdown takes place, it could soften the corporate revenue growth and credit growth. Lower nominal GDP growth, if it is around 9-10%, implies possible EPS cuts, which are being factored in for earnings for Nifty and other stocks. Hence, monetary easing will have to help. That is why the more rate cuts and more liquidity in the markets should help the earnings and other issue. The other point is that once the rate comes down, when there is a rate cut, the P's always expand. Hence, so you start giving higher P's to the same stocks as compared to earlier. For India, the significance of trade deal with US goes beyond trade. Right now, there is no clarity on that issue. 9 July is the deadline for the trade deal. India seeks US collaboration in defense and other high-tech areas, and India is looking for removal of reciprocal tariffs and lower import duties on labor-intensive products such as garments and leather goods, etc. While US is asking India to open up agriculture and dairy sectors. Without the deal, there would be a tariff disadvantage because other nations would have lower tariffs. So the exporters would be under pressure. So let's see how it plays out. Uh, the other issue was SEBI's decisive action should restore confidence among option traders and help re-establish the natural market movements that are essential for healthy price discovery. So it has indicated that there is zero tolerance for market manipulation, and sudden volatility seen especially on expiries was not random market movement but manipulation. So hopefully it should be over. IIP have shown. Now coming to FI data. So if you see here, FIs are adding short in index futures. Now if you come to index options, here if you see, they have added call options. So basically they have bought calls as a hedge against their index future positions, but they have bought puts also. So their focus is downwards only as per the data of end of 4th July. So most probably, if this is indicated, it indicates a kind of a downward trend. Now come to pros. Pros are indecisive in terms of index futures, but they have they have bought calls and they have also bought puts. So they are indecisive. They are in between, generally at the same level. So they are actually hedging their positions like this by buying calls also and buying puts also. So nothing great about this. Coming to clients, clients have uh, they are actually counterparty to the FIs, but in index options, they have sold calls, so that means they are bearish, and they have also bought put options, so sold put options also. So they're also in between. So they're all waiting and watching and slightly creating positions for any trend to work out. So nothing great is coming out of this. Coming to the monthly data, so if you see here, from around a lakh or OI positions for FIs in index futures, it came down when they did a lot of short covering on 26 June to 34,000 odd short positions, and now it has gradually increased and markets rise has also faltered. So if you see here, on 26 June, that was the expiry day, they did cash buying, they did short covering, and so the index rose 1%. So the 1% days have been where there have been lot of short covering and positive buying. So that are those are the actually the 1% move days. Otherwise, it is just normal movement which is taking place, and index is gradually going up. Now coming to the US, if you see, the sentiment was driven by trade deals and strong June jobs report. S&P 500, as I told you, has topped 6,200. Trump announced a trade deal with Vietnam that helped the sentiment, which was favorable to the US. June non-farm payroll reading came in higher than anticipated. So if the job markets are strong, that means the July rate cut is off the table. They are looking at now September oblique December rate cuts. One big beautiful bill act was passed in both House and Senate, and the president signed it as a law on Friday. Trump said that he will not extend the current pause on reciprocal tariffs and start sending letters to trading partners specifying tariff rates. So that is what is keeping the market slightly subdued last week. Hence, so if you see here, the bond yields were coming down, then they rose because the jobs report was strong, but it is nothing alarming as such. Similarly, dollar index. So if you see, it is declined slightly. It is coming to these 94 levels, and as it will come down, it will help the metals, and the reinflation trade will take place, because if the dollar is coming down, the emerging markets always do well. Brent crude rose around 3% from the lows, but I think it will come down again because now I think OPEC is having a meeting to increase the output, and Trump is very much against the crude prices going up. Gold is also below the trend line, but it was slightly positive, but basically because of slight amount of big beautiful bill and more spending and more debt, etc. So the money started moving to other assets. Silver is continuing with its move up. So it was slightly up, but it has not declined. It is above this last high, and till the time it is above this high, it should continue to do well. It's an industrial commodity, so it is expected to do well as the dollar weakens. The other place where the weakness in the dollar has been seen is in copper. Copper is made a fresh high last week, so it is expected to do well. Bitcoin was flat. It was trading higher, then it halted, etc. But it continues to do well as the uh, money moves from dollar to other asset classes. S&P 500 is above the highs it made in February, and with a fresh high topped out 6,200, is now heading higher. Nasdaq was up 1.48%, is moving up because that AI rally is back in the US. And Dow Jones is also now going to enter, was the best performing, 2.3%, is going to enter this rising trend line shortly. So they are expected to do well. India VIX declined, and it has come down to 12.32 level. So now below these levels, it will indicate only complacency, because now everybody is not is pricing. There will be no problems. Everything is sorted out, etc. So that is a big risk right now. Now, coming to Nifty, it was a kind of a subdued week. Nothing much happened for the week, 0.69%, but nothing wrong. Trend is still up. It has not broken any key levels. Last week was a big green candle, so it is just consolidating now. So no alarm. For Nifty 50 daily chart, so if you see here, it went and tested that gap which is there from around 24,640 to 24,750. This gap was created in October. So this gap has been tested, but it should be a small resistance. So eventually the index will come, maybe test the 20 EMA, gain strength, and then move up and make the fresh high. Maybe it may happen with the result. And it is also consolidating before the earnings season, as they're trying to see how it works out. Hourly chart, if you see here, for the whole week or so, it just generally was mulling around, and then at the end of the week there was some short covering, so it went up and closed above the 20 EMA, which is positive. Nifty Bank again similarly tried to go up, has come down, so it is now at around 57,000 level, which is critical, but it is the best performing index as on date, so should continue to do well. On the daily charts, again, it is making a kind of a flat pattern. It is extending its stay above the 20 EMA. So till the time it is above 20 EMA, it is good, above 57,000. So nothing much is happening. Main indices are signaling that the coming move is upward only. There is no downward move, so don't short this market. Hence, holding positions for larger gains becomes possible. So swing and positional trades are back. You don't have to do intraday trading now because VIX has eased, and earning season will start now and will bring focus back on mid and small cap space, because right now the action has been more on the large cap space, but once the earning season starts, the focus shifts into mid caps and small caps. HDFC Bank is tried to go above 2000, has not been able to, getting rejected. So let's see, it will take support at the 20 EMA and then try to go up again. Results, though, if you see, the business update was nothing great, pretty subdued. Same with Reliance. It tried to go up. It has could not really sustain the momentum. So it is not yet breaking, but the key support is this 1480 level. So this 20 EMA should be a critical support. Switch off your volumes, please. Mid caps are doing well. So if you see, it has touched and gone above the previous all-time high. Hence, it should do well. Right now, it is consolidating there, but once it breaks out from here, based on results, it should go up. So this mid-cap select index is the one which is in good momentum. Similarly, with small caps, it was higher than it made a higher close from what it closed last week. So it is now heading to its next all-time high or previous all-time high. So let's see where it goes. So it is basically indicating strength right now. So overall, if you see, the first quarter has ended, a volatile quarter due to geopolitical risk. Now we have to shift to domestic mindset and be stock specific based on earnings. Uh, there are some doubts among the people due to GST and advanced tax numbers are slightly below par, but markets are always forward looking and start discounting 6 to 12 months forward. So it should continue. The winning streak for last 3 months should continue, and GDP growth of 6.5 to 7% will play out with rate cuts, and there will be momentum due to government spending and tax cuts, which they will help all these things. And you can see right now, even now, the government spending part is the part of the economy is doing well. Uh, and the positive aspect is that still there is a lot of ammunition with RBI. So if growth doesn't takes off, then there will be more rate cuts. Inflation is not a problem due to crude and food. Food in India, the major issues was food. So monsoons are decent. So food should not be a problem, and crude is coming down. Coming down. So crude is an input in all aspects. So it should keep the inflation low. Hence, that issue is not a problem. Uh, so the positives are good monsoon, and US wants Iranian crude in the market. Hence, the crude prices are coming down, and they are trying to have a lot of good deals. So the basic issue with the deal with Iran is for getting their crude into the market. So there is no World War III happening. Now corporates would be, and the tariff issue will finally get resolved. So corporates will start doing their expenditure and capex. First quarter is generally better, and that's why the July is a good month for equities. I think probably uh, put people recognize more revenues in the first quarter of the year. So the trade setup for the markets is good. So don't be a bear in this market. Uh, Talking about Jane Street, it has no major impact on other than capital market stocks on the markets. It should help the option markets, and option buyers will be start making money right now. Though right now they are not making money, how it will help is that your hedging cost will come down, which will improve profits, because right now the markets are not following trends. So volatility though has reduced, but there is one major factor which people are not factoring in, is that in case there used to be earlier a 500 or 1,000 point move on Nifty, all stocks used to go up. But now what is happening is there is too much of rotation among stocks, because everything is not going up together. So one day one part of the market goes up, second day the other part of the market is taken up. So that sector rotation is what is happening, is that the indices are moving, but the stocks are not moving, because at the end of the month, if you see, your portfolio has not moved. So as a market participant, I'm not looking at conspiracies, but looking at trends. So and try to take advantage of that. So right now, the broad-based moves in the markets had stopped. So which should now start off, which was not normal, because earlier, if you remember, everything used to go up together, other than sectors which were in problem. But now that is not happening. So good, there is a cleanup. Opportunity should be there to to make more money for the retail now. So which is positive. Talking about the other factor which is very important, which I have highlighted, is that dollar is going down so it's in a bear market now. Hence, metals should do well. It is already manifesting in terms of silver and copper, and below 93, 94 level, which I indicated, would be a long-term trend reversal for dollar, which will take place. So it will go into a bear market. Hence, we need to play the weak dollar scenario, which is already seen in terms of certain metals, but it will subsequently play out in terms of all metals. So as I was discussing about US bond market, so that problem is also over. Trump will get a dovish Fed governor who will see, we will then see lower bond yields and lower dollar. And Trump is definitely targeting lower inflation, so that is not a problem. Hence, the geopolitical risk and US bond market risk are etc. are now going down. And for India as such, now we have to look into earnings, stock specific. There is low inflation, negative rate cycle will trigger economic growth, and markets are anticipating that. And as they are forward looking, they are moving up. Simple and straightforward. This is what is happening right now. Now, coming to stocks, first I will discuss Affle 3i Limited. It's a global technology company with a leading market position in India. The company has two business segments, consumer platform and enterprise platform. The consumer intelligence platform delivers consumer engagement, acquisitions, and transactions for leading brands and B2C companies through relevant mobile advertising. The company owns an in house data management platform with a reach of over 2.4 billion connected devices. The company enterprise platform helps offline companies to go online through platform based app development, enabling online to offline commerce and data analytics. So, basically, two business segments they have, but their consumer intelligence platform is the major business, which is basically doing the digital advertising. Advertising spends on mobiles are expected to report a 32.5% and 18% CAGR respectively in India and Southeast Asia in the next 5 years because of rising active internet users, rapid adoption of smartphones and connected devices, and a young population. It is fundamentally broad based and focused on verticalization across EFGH categories. I'll cover what are these EFGH categories. Ex, uh, Expects e-commerce to lead growth globally, followed by gaming and entertainment. It expects margins to expand by a few basis points in FY26, supported by cost efficiencies from intelligent automation, AI-supported workflows, and stable employee expenses. So the other key issue for them is that the margins are expected to improve. It has a unique CPCU model. I'll discuss it in detail. CPCU is cost per converted user. That means revenue is earned when user is converted to a consumer by clicking on ad followed by download or registration. So it is not based on just viewer based and how many people have watched your content, but converted user based. So that is helping them. It's a scalable and profitable outcome for brands globally and thereby enables it to achieve strong, sustainable medium to long term growth. Now, coming to their financials, so they did around 600 crores revenue in the last quarter, 19% year on year growth. And for the full year also, they grew around 23%. So that is strong. Though Q and Q, they were flat. EBITDA grew 36% because margins have improved roughly around 300 basis points. And profit after tax has also improved. Profit after tax improved around 28.5% year on year. So they had a strong year for the FY25. Now the model is cost per converted user, CPCU business. So they convert new users online, existing users, repeat conversions, and new existing user conversion takes place. So that is how this model contributes to revenue. Now, if you see here, uh, in the last 12 months, they did number of conversions were around 392 million, that is 39 crores. So the number of conversions are improving. Average cost per converted user is improving now every quarter. So the total CPCU revenue is also improving. And this is what is their basic revenue. So they did around 2,256 odd crores last year because of this, and that is what is helping. So if you see here, uh, that is roughly where their total revenue is coming from. So it's a predictable model based on average CPCU, what is the rate which is prevailing, and what is the number of conversions they are able to do. So they are doing around 29% CAGR growth of conversions. So once it improves, once the conversions keep going up, it's a simple model. You have to multiply it by the CPCU and you get their revenues. Now I was talking about EFGH. So E is e-commerce, entertainment, education tech. EFF is fintech, food tech, FMCG. G is gaming, groceries, government jobs, and H is health tech, hospitality and travel, home and other utilities. So they are direct to customers revenue contribution is improved and it's around 76%. So there is nothing in between as such, no no intermediaries in their business. So if you see strong revenue growth, around 24% regularly, so that is the CAGR. EBITDA margins are also improving, ROE is improving, and ROC is also improving. So they have improved their operating margins year on year. So now it is in 20 plus category. So they are expected to do around 2763 crores. Uh, FY26 year on year growth of around 20%, and then they will follow it around 25-26% growth in FY27 also. EPS is around 32.9 for FY26, around 41-42 for FY27. ROE is improving, ROCs are improving. So at around, if you even take FY27 earnings, $40 EPS, 50 times at 2,000 rupees, it is fully priced right now. But so it's a expensive stock. So if you see, but it has risen up from the lows it made on April 7th. So now it is at around 2000 only exactly. So in my opinion, FY27 earnings are fully discounted. So we'll have to see for this quarter results, but it's a good business. In among the IT businesses which are not growing, it is better to be with such businesses which are at least growing 20% revenue growth and 30% profit growth. Hence, look for a dip to buy this. Somewhere around this 1930 level should be a good level to buy. Right now it is trading constantly above the 20 EMA. So let's see if we get a dip here. It's a good business, and long term, if you see, it has done well. So there is nothing to complain on this issue. The other stock is Acutaas Chemicals. This was recently in news. It has two segments: advanced pharmaceutical intermediates. So they provide these APIs to various pharma companies, and market leader for key intermediates across the globe. Specialty chemicals. They make these parabens and paraben formulations. Paraben is basically chemical used in cosmetic industry. So this is where it is used, and other key starting materials for cosmetics, fine chemicals, and agrochemical companies. They are getting into semiconductor chemicals business through Baba Fine Chemicals. It is their subsidiary. Only Indian player in photoresist chemicals, electrolyte additives used in manufacturing cells for energy storage devices, etc. So they are into semiconductors and electrolytes also. First company in India to manufacture electrolyte additives. Electrolytes are basically used in making lithium-ion batteries, etc. Uh, so what they have done is they have announced a joint venture to manufacture semiconductor chemicals in Korea, which should be positive as it promises a faster ramp up of this line of business. They have a wholly owned subsidiary, Baba Advanced Materials, that will invest 190 crore into a JV called Indichem in return for 75% stake, while J&N Materials will hold 25% stake in return for providing technical and managerial expertise as well as marketing the advanced semiconductor chemicals. J&N Material is a South Korean company which is in this field. The plant is expected to be up by September 26 and is expected to achieve peak utilization within 3 years with peak fixed asset turns of 1.5x and EBITDA margins of 50%. So this is the key issue. This business has huge, very high EBITDA margins. I'll show you as compared to their other businesses. Indichem will generate revenues of 20 crore in FY27, 100 crore in FY28, gradually ramping up to 280 crore by FY30, assuming 50% EBITDA margins for Indichem and further value captured by Baba via the supply of precursors to Indichem. Its overall semiconductor chemical business will generate EBITDA of rupees 210 crore in FY30 on revenue of 340 crore. So it's a high EBITDA margin business. So if you see till now, their present performance, Q4 FY25 financial performance, so they did, even without this semiconductor thing, they did around 37% revenue growth, Q and Q, and they did 40% growth for the full year. Uh, EBITDA grew for this quarter, Q4, it grew 96.8%. For the full year, the EBITDA grew 80%. EBITDA margins have improved roughly 800 basis points, which is big. And profit grew 144% for this quarter, and 98.6% for the full year. So it's a very strong results they showed. So if you see here, the business where there is most growth, advanced intermediates are growing around 29-30%, but chemicals are improving 83%, though it is small part of the business, just 15% right now. So total 30 or 33% revenue growth. So by business vertical, so if you see, chemicals are 15%, but it is expected to improve, and exports are improving. So FY25 exports have nearly doubled for them. So if you see here, FY25 overall revenues were around 1,000 crores. It is expected to be around 17 or 1800 crore. That means 80% growth, or 30-35% CAGR growth over the next 2 years only. And semiconductor chemical part is expected to grow pretty high. So from 24 crore is expected to be around 343 crores in 2030. Because 26 they will start production, and then it will grow exponentially. Now, if you see here, the margins, the pharma intermediates is 25% margins, electrolyte additive is 10% margins, semiconductor is 51% margins, rising up to 61% over a period of time, and other specialty chemicals is around 10%. So the margins will improve drastically. Hence, there would be an improvement in ROE and ROC, etc. So if you see there overall, from 1,000 crore, they are expected to keep growing their uh, revenues, and from FY27 to FY30, it should double, more than double the revenue. So that is what is expected, and profit is also expected to double from FY25 to FY27, and then double from there again. Uh, EPS is also improving. It is expected in FY27 around 38 is expected. You can easily trade it at 35 to 40 times because of the kind of growth they are offering. So that it should easily trade at around 1500. Cash flow from operations is strong. EBITDA margins are improving. They are expected to be 24.8%, and ROC is also improving. So this stock is in a downward channel because I think there is a scare of API threat to pharma, etc. So how it will take place and all. So it is subdued. So everywhere, every time it comes to 1100, it's a good buying opportunity because for the long-term view of the business. So this is it. I have finished. We take questions.